This will be a rather lengthy explanation of financial analysis tools. I'm going to go through it fairly quickly because there is a time limit with YouTube videos. So the standards of comparison is intercompany, competitors, industry, and guidelines. It's what I'm looking at, what I'm comparing the numbers to. And the tools of analysis, you could use horizontal analysis where you're comparing financial statements across time. A vertical analysis where you're comparing it to a base amount. Income statement base will be revenue. Balance sheet base will be total assets. Then ratio analysis, it's a measurement of the key relationship between the various financial statement items. Four broad categories for ratio analysis, as it's usually presented in an accounting principles textbook. What is it? Liquidity and efficiency. This is your ability to meet your short-term obligations and to efficiently generate revenue. So think of liquidity as current liabilities coverage, and efficiency, it's how effective are you at utilizing your assets to generate revenue. It's also called an activity ratio. Focusing on your current liabilities, and here are the various liquidity and activity, also called efficiency ratios. We'll look at these one at a time very quickly. Current assets minus current liabilities is your working capital. It's expressed in dollars. You have to have working capital to operate. Current ratio, it's where you stand. A high current ratio will suggest a strong liquidity position and the ability to meet your current obligations, but you don't want it too high because that's going to mean you're not utilizing your assets effectively. Instead of a subtraction, it's a division. Current assets divided by current liabilities, and this is how it's expressed. This would be 2 to 1 as a general guideline. The acid test, similar to the current, only it excludes some of the assets. It excludes inventory and prepaids, reflects extremely short-term liquidity because you think if you're strapped for cash, you may not be able to turn that inventory into cash very quickly. So you have the current ratio, looking at all current liabilities, and then you have the quick ratio or the acid test. Cash plus short-term investments plus current receivables is your numerator. Another way to think of this is just take current assets and subtract inventory, subtract the prepaids. 1 to 1 is a general guideline. This is also called the quick ratio, your quick assets. So accounts receivable turnover, the next one. This is what you're looking at to analyze your credit terms and your collection efforts. How well are you able to convert your receivables to cash? And you do want to include short-term notes receivable in addition because those are often related to trade receivables. The higher is good but not too high. You don't want to alienate your customers. And it's net sales divided by a simple average accounts receivable, January accounts receivable plus December accounts receivable. Simply divide by 2. It's not a weighted average, and it's expressed. It's a turnover. How many times did it turn over? The next turnover is inventory. It's how long are you holding on to inventory before selling it? Is your cash tied up in inventory? Higher turnover will require a smaller investment, but you have to have balance, so it is a measurement tool for inventory management. Inventory turnover is cost of goods sold divided by average inventory. And it's a simple average. Now we're going to compare the two. It's a memory trick to look at what numbers go where. Is this the traditional perpetual merchandise inventory, journal entry at the point of sale? You're going to have a revenue side entry and an expense side entry. The accounts receivable turnover will use numbers only from the revenue side. The inventory turnover will use numbers only from the expense side. Another memory trick, accounts receivable turnover, AR is on the bottom, it turned over. What is accounts receivable related to? Sales. Here's another one. Inventory's on the bottom. You turned it over. It's on the bottom. What's it related to? Cost of goods sold. Just another memory trick. Now, day sale uncollected is related to the accounts receivable turnover. Measures your ability to collect receivables, customers' financial health, their payment strategies, and the effectiveness of the discount terms you're offering. Do include short-term notes receivable in the numerator. It's the amount of time. So really it's taking the accounts receivable turnover and converting that number to days. And it's expressed as days. Now there's two different ways to calculate it. I want you to look at the close relationship to the receivables turnover and the days sale uncollected, where the numbers come from. This is one way to calculate it. Here's another way to calculate it. The same relationship exists for the days sale in inventory and the inventory turnover. You're just converting your inventory turnover, the total, into days. And it is another inventory management tool. Here's the calculation expressed in days. Now let's look at the relationship between the inventory turnover and the days sale in inventory. Here's one way to calculate it. Here's another. Total asset turnover, finally, the efficiency of using your assets to generate sales. That's what they're for. Net sales divided by a simple average total asset expressed in times. It's a turnover. And to summarize your liquidity and activity ratios. Now we'll look at profitability. This is the measurement of the success or failure of your company over a given time. Are you able to generate adequate return for your investors? Various profitability ratios. First, the profit margin. This is a comparison of net income to sales, or your ability to earn net income from your sales. It's a measurement of operating efficiency and profitability. Now, both the profit margin and the asset turnover ratio we looked at earlier in liquidity and efficiency category, those are two basic components of operating efficiency. Profit margin is net income divided by net sales. It's a ratio. It's expressed as a percentage, as is the gross margin. And what is the gross margin? Percentage of dollars available to cover any remaining expenses after cost of goods sold. Think about the multi-step income statement, how it's set up. And how do you calculate it? Here's another way to look at this. Gross margin, it's just another term for gross profit. Take gross profit divided by sales, that gives you the ratio. Return on total asset will measure how well your assets produce income, the overall profitability of your assets. Net income divided by a simple average total assets expressed as a percentage. Return on total assets. Another way to calculate this, if you take profit margin, multiply it by total asset turnover, look at where the numbers come from. That is your return on total assets. Just another way to calculate it. Segment return, we're talking about a consolidated financial statement where you're looking at different subsidiaries within the total numbers. Financial analysts might be concerned for this, so think of the subsidiaries as the individual segments. Here's a comparison of total and segment. Very similar. Return on common equity. Analysis of concern to investors. That's what this one's important to. Now look at the numerator, net income minus preferred dividends. You're only concerned with net income that the common can get. They can't ever get what you're paying the preferred shareholders, if there are any preferred shareholders. And the denominator is going to be a weighted average this time instead of a simple. For that numerator, if it's cumulative preferred stock, you're going to subtract declared and any dividend in arrears. If it's non-cumulative, there aren't any dividend in arrears. book value per common share, basic earnings per share. A couple more calculations for profitability, basic earnings per share. That bottom is a weighted average. Basic earnings per share, or EPS, is a profitability ratio that will be used when we look at the last category, when we're looking at market activity. So solvency, the coverage ratio measures the security for long term. So if you recall, liquidity was current liabilities. Solvency you can think of as coverage of long-term liabilities, those bonds and notes. Solvency ratios, the various ones we'll look at. Debt ratio. It's a measures the relationship between your assets and your liabilities. This is an impact on leveraging, financial leveraging. You're looking at the amount of overall debt as it compares to total assets. The assessment of the risk that you might default. This is considered creditors' financial leverage. Total liabilities divided by total assets expressed as a percentage. Equity ratio is calculated very similar. It measures the relationship between assets and equity this time instead of assets and liabilities. What is your total overall equity as it relates to assets? And this would be your owner's financial leverage. Equity divided by assets. And the total here should equal 100%. Now looking at just debt and equity, not the assets. Now debt must be repaid with interest. So companies need to decide, do they want to finance with debt or finance with equity? There's no clear answer. It's going to depend on the company's needs. A larger debt to equity ratio will imply less opportunity to expand. So you're looking at debt versus equity financing. Liabilities divided by equity. Here's one that may or may not be in your textbook. Pledged asset to secured liabilities. Times interest earned. This is a measurement of protection in meeting interest payments for your creditors. So the higher is better, and banking institutions will be very concerned with this ratio for companies applying for loans. Because if you can't meet your current interest payments, they're not going to loan you any more money. It's a times income before interest expense and income taxes. So you take bottom line, net income, add back in interest expense, add back in income tax, and then divide that by the interest expense. Or you could see a line item on a lengthy income statement that has income before income taxes and interest already provided. Final category, market measurement for analysis of corporations of publicly traded stock. You're looking primarily at current stock prices. Is it a good investment? Now keep in mind the stock market can be fickle. On a very active day, you could have stock over or undervalued. Price earnings ratio and the dividend yield are the two we'll look at. This is the analysis of expected future cash flows. Most popular investor analysis tool, actually. And you're looking at earnings per share as it's applied to the current market value, also known as the PE ratio. What is the market willing to pay for the company's current earnings? Market price per share divided by earnings per share. Now keep in mind, the numerator may not be a good number to go with an extremely overactive, overinflated, or depressed stock market. And the basic earnings per share, again, the calculation. How do you get the denominator? So the earnings per share, again, is one of the most commonly used tools of ratio analysis. It's the amount of income earned by a company expressed on a per share basis. Shows how your stockholders' value in the company has changed due to the results of current operations. And don't forget to subtract out any preferred dividends if there are any preferred stock outstanding. And quickly to show you how to do a weighted average. Let's say you had 500,000 shares outstanding for the first 9 months of the year, and then 100,000 more were issued. Another way to calculate the weighted average. This is not a simple average. Dividend yield, the final ratio. Payment of large dividends on a regular basis are referred to as income stocks as opposed to growth stocks. And these are attractive to investors who want recurring cash flows from an investment. Stocks with little or no dividend incomes can still be attractive because of the rapidly increase in value or the price on the stock market usually. Income stocks tend to have market price rise much more slowly than growth stocks. And this would be your calculation. Do be careful when you look at dividends on your disclosures. Many pay out quarterly, so make sure you're determining what the annual is. Divide that by the market price per share. And that was a review of